I am liquid. I can pay my bills, but I can tell you right now, occasionally a bill vanishes. I don't know what happens. It falls maybe between the seat cracks when my wife literally picks it up from the mailbox and drives down. She puts it in a drawer because she's cleaning up because friends coming over. And I'm like, I just got another water bill and it says I didn't pay last month's bill. What the fuck? You know what?
Yeah.
It happens to people that are on top of their shit, in other words, so to speak.
Yeah.
And I could have something on my credit right now and don't even know it. And I won't know it until the next time I go to leverage my credit.
Yeah.
That's
And I think a lot of times, and I'd like the consumer base to hear this, is like, you got to monitor your credit. Because you led me, Jeff, into a great segue of just a lot of people don't know what's going on in the back end, especially a guy like you own a home or something. Maybe the 22-year-old you're going to purchase him or her a car. And you're like, you know what, I'll finance and I'll give it to you. And you go down to the car dealership and all of a sudden that bill that you forgot to pay, all of a sudden it's there, it cost you 60 points on your credit. Instead of getting a 6% interest rate on your child's car, you're getting a 22% interest rate.
We are in a shitstorm of an economy and a real estate industry right now. And I don't know if there's any better way to describe it than that. It has just been a rough couple of years. And anybody who says otherwise is pretty much lying. It has been a challenge. Maybe it's a different challenge for different people. But here's, I think, what's most important and where everybody needs to kind of channel their focus is really digging deep and understanding how to make opportunities. And that's part of the reason why we brought our guest on today, because we need to talk about some of the nuances around credit and qualifications and just some of the things that you can better guide your consumers to put them into qualifying to buying a home. And that's why we're bringing on Anthony Iacobucci. No idea how you got that out of that spelling, but I'm going to go with it, Anthony, with UQAL. Thanks for being here, brother. I'm excited to have a conversation with you.
Thanks so much for the invitation, Jeff. I really appreciate it.
Absolutely. So, Anthony, let's start with your story. Who the hell are you? Where do you come from? What led you to where you are today? Give us the tea on that.
Sure. So I entered the banking world around 2005, which bright-eyed and bushy-tailed seemed like it was going to be my trajectory of a career. Spring forward 3 years, we feel the greatest financial recession in not only our lifetimes, probably ever. And it kind of dumped me in a position of which, I was trying to keep my head above water, trying to find work. I mean, obviously from a banking institution perspective, no one was really hiring. Cost of funds were through the roof. It was a complete and utter mess, which kind of fell into the UQAL platform about 3 years later, about 2011, where I had been leveraging myself from keeping myself above water to pay on a mortgage, and credit kind of hit me square in the face in regards to trying to pay my own bills, as well as trying to find myself in my mid to upper 20s a new career. And luckily, a credit spilled upon my plate, and I've been doing credit education and credit restoration and loan readiness really since that time.
Wow. So did UQAL actually come around that long ago, 2011?
Sure. So the inception of UQAL, quite frankly, was only about 2 years ago, but the successor, the parent company, National Credit Holdings, started in 2004. So I think I was their 18th employee that they had back in 2011, where we kind of sprung off like a rocket ship, and we've morphed like any other organization over time, and partnered with UQAL, which is our fintech application platform for the consumer in the midst of the home buying process in early 2020.
Right during the other shitstorm.
Yeah, timing apparently is not my thing, but
So, when you mention, first of all, I said, wow, because, when I think, and, my background is mortgage long-term, and I've since really evolved out of mortgage, but, so obviously I dealt with a lot of credit repair type people. And, my perception of a credit repair person was always, it just seemed like they came and went. And I think that's why I said, wow, because you've been doing this for so long. And part of the reason I feel like it's a volatile business is not so much necessarily about the product, because I never really met a product that really kicked ass, but I don't know that it was the product's fault. It was probably more the consumer's fault. And so when you think about, credit repair, are we in the same stadium of conversation here, or am I kind of off base when I describe it as credit repair?
Not at all. We never forget what our foundation was, what our legacy product was. But as times evolve, as regulation evolves, that's where the UQAL platform really came to fruition. But I'd like to kind of address, the latter of that is, you know, credit repair, quite frankly, had a stink on it for a very, very long time. Unfortunately, for an organization like ours that was fully licensed and bonded by all 50 states, vetted by various mortgage companies in which we worked with, we were always in the midst of rough waters due to the fact that there was always a local mom and pop shop that said they can do credit repair and things like that, credit rehabilitation and things like that, which always made it difficult for us. And quite frankly, Jeff hit the nail on the head. They're very much fly-by-night organizations. It was always a guy or gal doing it in the garage that had a relationship with a local mortgage company or two, and they thought they knew how to leverage the bylaws of the Fair Credit Reporting Act, which is the premise of credit restoration to begin with. So it always made it a little bit tricky. But springing forward in the last 2 years, going more of the fintech route where there's automation, which helps us with the regulation, allows us to really have a more efficient and seamless process for our consumer base.
So what kept you around? I mean, so my perception was accurate, and you know what I would equate it to today? It's like, I feel like credit repair 5 to 10 years ago is like what crypto is today. And it's like you get these DMs from people and everybody's doing
Yeah,
crypto. And there was a time and it felt like everybody was doing credit repair. And obviously, I guess my perception was accurate, but how did you sustain?
great question. And I don't want to sound cheesy to the audience. I gotta be frank. It was the people. Uh, Being education based, being mortgage centric, understanding the journey a consumer takes from start to finish to get them into homes. That's what we specialized in. Also, I think the premise of our program was aligning ourselves with major mortgage professionals. I think a lot of the other credit repair that you've heard of, maybe a Lexington Law of the world, they've always honed in on the end user. What our formula has always been is cultivating a team on the back end for a borrower that has some trials and tribulations of credit, coming together with the mortgage professional and the real estate agent, working on a comprehensive plan for that specific person that was personalized. And I think that's another added component I want to add in there. That variable of being personalized, I think that was differentiator between us and everybody else. There's very cookie cutter stuff. But if a Jeff was in our program, Jeff had a specific plan. It was different than Jane's. It was different than Joe's.
Okay, so what about the other statement where, and this was just from personal experience, where it always felt like, you know, when you're a successful originator or real estate agent, and you get somebody with less than ideal credit, and it's going to be a challenge, it's typically like, brush it aside, right? I don't have time for this. Here's a credit report, whatever, credit agency, you just go there. And you didn't mess with it. So there was a time when that was me. I just didn't like, I didn't follow up. I didn't follow through.
Sure.
And then I know there was a time when I was also starving, and I was building my business, and then every deal mattered, and I would nurture that deal with the credit repair. But either one, I felt like the percentage of success was very low. And I don't know if that was my fault for lack of follow-up. Was it a shitty product, or was it what I think is borrowers, consumers, I hate to say it, but once you have crappy credit, you tend to it's like a lifestyle and you don't ever
Sure.
get out of it. And so what's your take? What's your professional take on that?
Yeah. I think it's a little every column A, B, and C, quite frankly. You can giving timeframes is probably the most difficult thing we can do in our industry. Quite frankly, we don't. But let's just say we tell a consumer, hey, it's going to take 6 months to get you out of this shitstorm, right? After 6 weeks, they want to know why it's not done, and they become disenchanted with the process, and they fall out of the program. I think the follow through a lot resided on the shoulders of the consumer, understanding like, listen, you didn't get here overnight, right? And like you said, people habitually were bad borrowers in the most part. There has to be a behavioral change in the consumer's way of purchasing or financing or their daily activities, which oftentimes was difficult to do. You can't talk to somebody every single day and smack them on the wrist because they're, throwing another $1,000 in a FanDuel account, or signing, getting Grubhub delivered to their house 3 times a day. Just can't do that stuff. I think that's what we'll get into the UQAL platform, how that can kind of address those issues. That being said, yeah, I think there was a little of everything, right? I think a borrower needs to really look themselves in the mirror, and quite frankly, a lot of them don't. And also, I think a lot of times the system, Jeff, quite frankly, is built to be predatory against those folks. That's what keeps them in that vicious cycle. You or myself or you with a 780 plus credit score and liquidity, things like that. The system isn't geared to take advantage of us from interest rate gouging or bad finance terms, things of that nature. It's built against someone who's got a 550 credit score, which kind of keeps these folks in a vicious cycle. And I understand the anxiety and the trials and tribulations that come with it, because it's a tough cycle to get out of.
Yeah, that's interesting. And I have to digress and say, did you put that money into FanDuel today? I mean, today, by the way, at the time of this recording, it's March Madness.
No, my fiance says I'm in gambling jail, so bad time to be in it. The Super Bowl didn't treat me that well, but it's a great time of the year to watch some sports for sure.
Yeah, I wish our audience was a sports audience. We could just talk about that all day, but I don't know I don't know many of them would appreciate this this quick shift, this pivot. All right, so let's get back to it. So talking in today's terms, because that's really all that matters. What is something that you probably see the most of as it relates to, the type of customer that gets referred into you guys that you then correct? And I think I'd love actually for you to give multiple examples, because really what I want here is we have a predominantly real estate agent audience, and I want them to understand, because I think a lot of them just, again, they brush this aside. It's the lender's deal, right? But I think as a real estate agent right now, we're all struggling. The business isn't flowing like it used to be. So you having a little bit extra knowledge might actually help you, and you help diagnose a customer who's wanting to buy but maybe can't. So could you give us some examples or some scenarios of something that maybe a realtor is overlooking?
Yeah, I think first and foremost, a couple of reasons, and I'll kind of talk about our main demographic. Usually we kind of, for the most part, most consumers are going to fall into 2 buckets in the need of some credit restoration or loan readiness, as we like to call it now. Is first and foremost is going to be medical debt. To this date, over $90 billion of medical collections are reported at a credit bureau level. And I know a lot of the real estate agents are probably sitting on this, watching this YouTube, saying, well, Anthony, Jeff, we don't need to worry about medical collections or medical bills from an underwriting perspective. Mortgage companies look the other way. 100% correct. However, first base of the transaction is, do we have a qualifiable threshold of a credit score?
Yeah.
Those medical collections indeed are affecting the credit score adversely, keeping consumers stuck in the mud. So a big time clients that we have, or excuse me, a big number of clients that we have are going to be medical related. Like $90 billion. Another bucket that we service a lot of is divorce related issues. I don't want to make this a marital thing, but we know that marriage is a coin flip at this point, right? A lot of folks are coming to us with severe divorce related issues in regards to assets being cut up by a judge, and maybe he's responsible for the house and she's responsible for the car. That being said, even though those assets are divvied up by a court, it doesn't mean the liability on the other spouse is exonerated. So that being said, oftentimes we have borrowers coming to us because maybe one spouse didn't keep up with the mortgage payment. Another spouse let a credit card fall into default. So those are kind of 2 of the huge kind of buckets that we fall in. And the third bucket, Jeff, this is going to be a tidal wave. $2 trillion of consumer credit card debt has been breached in early 2024. It's alarming. It is very, very alarming, with $2 trillion worth of credit card debt at the precipice of potentially being charged off, falling behind on late payments, rolling late payments. The default rates are going to skyrocket. We're very blessed to get a lot of analytics, and the forecast probably for the next 18 months from consumer credit is alarming. It's quite frankly, it's alarming. There's too much borrowing going on. There's too much financing going on right now. And that's right on the forefront.
Stay on that topic.
Sure.
Why? And I know this, I see this in the headlines. Why is it? Why are we at this place? Because, and I'm going to say it like this, coming as a Gen Xer, right? And you and I are probably the
Yeah.
same generation. And then you got the baby boomers, and I feel like they're as liquid as ever. I
Hmm.
think Gen Xers are most are in a fairly stable position. Or I shouldn't say most, but a good portion of that generation, just because of what they've went through, and because we went through COVID, and because most of us bought homes with low interest rates or refinanced into low interest rates. We're sitting in a solid position.
Sure.
So it can't be those two generations. But tell me, like, where is this coming from? Because I see these headlines too.
No, and that very, very smart point that you made. Yeah, the baby boomers, very, very liquid. By purchasing home, I mean, my parents purchased a home for $37,000 in the late 1970s, and they just sold for almost $2 million. I mean, that's liquid. Crazy. Our generation, we were very, very smart to get in early, 2010s and before really 2016, where a first rate reduction happened in regards to refis. But I read an interesting statistic. 62% of folks that are currently homeowners are holding interest rates below 5%. 32% of people actually have interest rates below 3%. So you have a whole generation of folks that are basically, if you have an interest rate below 4, in my opinion, that's free money. Hyperinflation in the housing market that has continued to go up. Housing prices keep going up and up and up. And the equity in homes are skyrocketing, giving us a very secure blanket, really, at the end of the day. It's the other generation that's dealing with hyperinflation outside in the economy in general, whether it's groceries or the day-to-day, and wages are not keeping up with it. And we're trajectorying into really a nation of renters, which is a very, very scary proposition. Because think about the baby boomers, or even think about our generation. We're not going to sell because I don't want to lose my 2.75% interest rate. Everyone thought that rate reduction was so fantastic during COVID. In my opinion, it could potentially cripple us for a couple of years, because you're going to have our generation 40 to 50 that are just going to sit there and say, you know what? I got 275. I got 3.25. It's free money. I'm not going to move around. I'll pull some equity out of the home because the equity's through the roof. I'll add an addition. Instead of getting a bigger home, I'll pop the top and add a third floor, redo my basement, something like that. And with the lack of inventory coming on the market and lack of building, because materials have skyrocketed as well, it's a perfect storm of keeping these next couple generations, quite frankly, as renters. And then I don't want to go too far off the reservation, but now you have major financial institutions, BlackRocks, Vanguard, investors coming in and gobbling up single family homes because they can get a better return for their investors on just owning homes rather than they can in the stock market, because houses are still going up 16, 18, 20% sometimes, instead of the natural healthy appreciation of like 4 to 7%, which is historic for housing.
That was my next question.
Yeah.
Was that conspiracy? John Castles and I, the guy who brought us together, have been talking about that.
Yeah.
It's a hot topic for him right now, and there's that conspiracy, and I know we're totally pivoting here outside the topic, but I think it's important to talk about, because if you're oblivious to what the conspiracies are, and I don't know that it is a conspiracy. I don't know what the motive is necessarily, other than control. But if you don't think the government has their hand in these companies that you talk about, and there isn't some sort of an intent to own as much real estate as possible, because that means they then own you effectively,
Mhm.
you're a little naive, right? I mean,
Yeah.
that's because that is what it looks like right now. And it's funny. I just forwarded. I have two kids, 20 and 23, and I forwarded them both a video on Instagram last night of somebody talking about Gen Z, and I don't remember the premise of the message, but the details of the message. The premise of the message was own, right? And I sent that to her, and my one daughter replied and said, "Not in this economy, we're not owning." And I think that, and she's 23, that is probably a very common a reaction from that age range just saying we can't afford it. It doesn't make any sense. I'll
Yeah.
just go ahead and rent. And they're completely oblivious to the fact that this isn't changing and going to get better. And before you know it, they're going to blink an eye, and 10 or 15, 20 years from now, they're going to have rented for their entire 20s and 30s.
Yeah. It's a systemic problem. And to be honest with you, Jeff, I don't know how we get out of it. I think
Education is it that's what I told John. I'm like, people like you need to go to social and talk about this, because we need to educate that generation that they just have to bite the bullet, because if you don't own now, you may never own.
yeah, I think that's a huge part of it. Yeah, from an education perspective, goodness, I when we were coming up in high school, I was still learning about ledgers and balancing a checkbook. No one told me about how to maximize my FICO score. You know what I mean? I was the kid in college. I don't know if you remember, Jeff, when we go to the student mailbox, there'd be a credit card offer right in there. You just call it up and activate a credit card. When I purchased my first home, shoot, at 29, and I saw my credit report that I had three $300 credit cards that had been charged off, that I owed nearly $5,000 on, with interest that had accrued and fees. I mean, that was kind of my kind of light bulb moment of like, what's going on here? So yeah, I mean, the education's a huge component of it. Trying to get out there and educate the younger generations of just how important it is to understand financing, understand credit, leverage it to, do things like build wealth, or build, just the common American dream of home ownership.
Yeah, yeah, it's crazy. And I know we could go down this rabbit hole, but obviously it's not the intent of this conversation. And it came to me, by the way, the message or the video was talking about how by 2030, most baby boomers will be out of their homes. And so you're talking about an influx. I think it was 20 million, I want to say, something crazy amount of homes that over the next 5 years
Yeah.
are going to enter the market, and you're going to have a massive influx of inventory. But I don't know that the prices are going to come down. So it's either you let big industry own it,
Yeah.
or you might have to not get your latte every day for a
Yeah.
couple of years.
Yeah, you kind of took the words out of my mouth, because I didn't want to get morbid with it, but I was listening to an economist say, like, the key to our housing market, and goodness, my parents are great, lucky, they're still alive, but we need the baby boomers to pass away and to open up inventory, and our generation, who's not going to, there's going to be so much profit to be made that we're not going to squeeze a buyer. It's just going to, hey, I've got a tertiary property in rural Iowa, I got to sell, I got a house in Florida that my parent, you know what I mean? If that's what it's going to take, which I don't think is very healthy for a general economy to be predicated on people dying. But that was kind of
Yeah.
the world, the avenue that he went down. So yeah, it's a
Yeah.
good point.
I mean, they're staying in place, I think they call it. And I think it's a product of also living more sustainable lifestyles that doesn't require them to need care. It's
Sure.
which, as you said, is also a blessing, because it means our parents are obviously living longer. And hopefully that means you and I get to live longer too.
Yeah.
They're going to be bitching about us in about 30 years.
Yes, sir.
Less. All right. So let's get back on topic. Sorry for that. But good conversation. So let's get back to you mentioned the three biggest targets, which is medical, it's divorce, it's credit card, and credit card by far is going to become, it already is, and it's going to become a massive issue. So, and you also mentioned, and I love you said this, okay, so medical collections may not have a negative effect on you qualifying, but they've had a negative effect on your credit score, jackass. Like, don't, that's what I want to be like. What?
Yeah.
Who would say that?
Yeah.
But your credit score now sucks. And so now you don't qualify, or you have a even shittier rate. So how does UQAL help? How does UQAL help somebody get over these humps, these challenges?
Yeah. Great question. So, obviously legacy, what our bones had been in the past was just focusing on credit. The great thing about the UQAL platform, it not only focuses on credit, it's going to focus on DTI, which is a pain point for a lot of mortgage professionals, real estate agents, that the box that they need to check with their consumers, helping a consumer save for a down payment. Like you said, let's cut out those lattes, let's cut out those bad expenditures and allocate it towards a down payment. So those are some of the premises in which the UQAL platform does address. In regards to credit specifically, we've got a very specific integration from a technology perspective with the credit bureaus. Again, predicated on a federal statute, and guys, you can look it up yourself, or I know this is a mortgage-driven audience. The Fair Credit Reporting Act is probably not something that is unfamiliar to anybody that's watching this right now.
Real estate.
Yeah, real estate. Yep. Is it allows you to contest the accuracy, the validity of your credit report. All the I's must be dotted, all the T's must be crossed on anything on your credit profile. Bad debt changing hands is not illegal, but misreporting it and not having all the documentation obligatory to follow you as a borrower, that is illegal. And that's what we strive to, really break the integrity of that paper trail that's obligated to follow you as the life of a borrower. I know it sounds a little technically, but that's kind of what we do for the consumer base is to uncover inaccuracies, whether it's an incorrect balance, a date, the creditor doesn't have the right account number, things of that nature.
Yeah. All right. So you just gave us the intellectual explanation. Now dumb it down for the idiots like me in the world.
Yeah. So we have the ability to get this stuff removed off your profile just through a verification of information. Creditors must have all their documentation in a row. So if a creditor doesn't have an original contract, an application, an invoice, if there's a insurance provider that is incorrect on a medical debt that's on there, that stuff can be alleviated off of a profile due to the fact that it's inaccurate.
So a customer, typically, if a consumer, obviously typically the process, they go to real estate agent, they want to look at homes. Real estate agent should say, go get pre-qualified first. I'm not going to waste my time. Lender in many cases might say, sorry, you don't qualify because you got this, this, and this in your credit. It's tough shit.
Right.
At that point is when either the lender or the real estate agent should say, you need to talk to UQAL, because they almost act as, it sounds like, your representation to help you do what is probably impossible as a consumer to get these things remediated.
Yeah, 100%. I mean, that's, being the fact that we are mortgage centric, mostly every client that we ever service is in the midst of the home buying process or looking to refinance. But yeah, I mean, that's kind of the stem of all our referrals that are to us, that someone comes up with a little bit of a hiccup during the pre-approval process. They want to have, really someone to fight the good fight for them at a credit bureau level. There is no bureaucracy behind TransUnion, Equifax, and Experian. There's no regulation. Quite frankly, it's three independent billion-dollar corporations that have invented a game that none of us really know how to play. And that's kind of what we do, the hand-holding for the borrower, because again, doing this stuff on your own accord, it becomes timely, tedious, having a strong partner like UQAL representing them at that credit bureau level. I think it makes a lot of our consumer base feel really good that they've got a professional behind them that knows how to push back on some of these credit bureaus. Not only on top of that, there's tens of thousands of different creditors out there sharing information, buying and selling of bad debt, and it's not regulated by any stretch of the imagination, and it is affecting the consumer base on purchasing a home. I've seen people, Jeff, lose 100 points on their credit score but because they didn't pay a $50 copay on a teeth cleaning.
That's ignorant.
So you're going to go from a 740 credit score that you had for 30 years to a 640 credit score over $50 worth of medical debt that hits your credit report. And now all of a sudden you're talking about an FHA product, you're talking about MI, you're talking about an 8% rate instead of a 6.5% rate over $50.
It's
crazy.
That's ignorant. Yeah.
Yeah.
I mean, how do they get away with this shit? I mean, is it because of what you said, they invented a game that none of us know how to play? I mean, that's a really good line.
Yeah. There's just too much money. There is just way too much money, because I don't think what people understand is the information on your credit report, it's paid to be there. It just doesn't magically just appear. So, it's a checks and balances.
A creditor pays to put that on your credit report. Is that what you're saying?
Yes.
I didn't know
Yep.
that. And that's how bad they want to get you.
Yeah.
Interesting. Okay, so give me an example. So give our audience an example, maybe a real example.
Sure.
Obviously not names or anything, but an example of somebody that went to work with you guys and you put them, you cleaned them up.
Yeah, I think some of the best success stories, quite frankly, have stemmed from 2020, the COVID years, where people just fell behind on their bills, that were inundated with medical debt. didn't know where to turn. The walls were kind of closing in, right? We're sheltered in place, and everyone, the grandiose idea of becoming a homeowner really perpetuated during that 2020, 2021 time. We have a lot of folks in that era that have come out now that are, sub 550 credit scores, that were able to get medical debt alleviated off of their profile, that were able to get some of the late payments on past accounts exonerated at a credit bureau level, and they've come out the other side to be borrowers in 2022 and 2023. I think those are kind of some of the great success stories, because it was one of those times in which we were the busiest that we'd ever been, but everyone was kind of going like this. No one knew who to turn to. No one knew who had to represent them or fight back on what was transpiring. So I think some of those are the great stories that are there. I mean, I had a woman out in Seattle, Washington. There's a creditor out there. I'm not going to mention the creditor's name, but it is after a body of water in the Seattle area. And she had $146,000 medical collection on her credit report on all 3 credit bureaus from a procedure that she had. I don't know what could have imaginably been $146,000, but we got it off all 3 credit bureaus. She was able to purchase a home. And to this day, that was about 18 months ago. It hasn't popped back on her credit report. So,
So how do you overcome that?
how do I, yeah, so that's a great question. So the statute that we use allows us to contest the accuracy. Medical collections have a high success rate because, not coincidentally, or I guess coincidentally, HIPAA's got very stringent guidelines against patient confidentiality. When we start poking and prodding for verifiable documentation of medical collections, oftentimes it's extremely difficult for a third-party creditor to get an insurance carrier information, a procedure that was done, a nurse that was in the procedure, or a doctor specific. So medical, quite frankly, is probably our bread and butter on getting removals at a credit bureau level.
It's almost like a loophole of a loophole.
Yes.
Interesting.
Basically, yeah.
Basically, it's like, okay, we're going to screw the consumer because we didn't get paid, but now there is a mechanism for you to kind of screw them back for screwing the consumer.
Yeah, I guess it's a good way to put it.
What? So what happens? What happens in an instance like that? Is it like does it just go away? I guess the debt doesn't go away, but it goes off credit. What happens?
Yeah, it was the latter, what you just said. It doesn't go away, it doesn't exonerate them of that debt, but does no longer affect them on a credit score perspective. And they are allowed to move forward with a score increase, as well as what may be needed from a financing perspective. So the debt is still out there and real. I don't want to act it and like I've got a magic wand that
You're not an attorney
exonerates them.
making the debt go away. Yeah.
Yeah,
Yep.
exactly.
Is that pretty common? Is that typically what you guys are doing, which is effectively you understand? I'm guessing that these creditors don't understand what you understand around in this realm, in this arena, and you know the nuances of how to say, wait a minute, you shouldn't have had the ability to just dump that on somebody's credit and destroy their credit.
Yeah, I think with the credit, I'd be naive to say they don't understand our situation, the premise of what we do to get it off. But bad debt changes hands so frequently. What doesn't is the obligatory paperwork that's going to verify why the account is being reported at a credit bureau level. That's obligated to follow you as a life of a borrower. Bad debt changes hands so frequently that paper trail never follows. And we really, expose the integrity of that paper trail. So that being said, do they know it? Yes. But I mean, here's how a creditor really works. An example is the best way to put it. I'm sitting here with a $500 collection on my credit report. I've had it for 3 years. I keep getting calls from unknown numbers, what have you. I go in to get some milk for the family. I buy a scratch off ticket. I win $500. My phone rings simultaneously. It's the creditor. I go, you know what? I finally got that $500 to pay this creditor off. Pay the creditor the $500, thinking that I'm done, that I'm good. Only to find out 30, 60, 90 days later that $500 collection has been sold to another creditor. And I'm getting calls again from another creditor. Is that illegal? 100%. Is it unregulated? Yeah, there's no way. You got to keep in mind, Jeff, there's 300 million people at a credit bureau level that are being reported, 3 independent credit bureaus, all autonomous of each other. The average American has anywhere from like 18 to 22 trade lines. Tough information to kind of keep track of. So the bad debt market, selling bad debt is not illegal, but not following the proper channels and having the proper paperwork to back it is illegal. But again, it's unregulated.
That's effed up, dude.
Yeah.
That's really effed up. And most consumers wouldn't know what to do with themselves. I mean, I think that's a testimony in itself. Like if you know somebody, if you're listening to this and you know somebody in that situation, which oftentimes, Anthony, we don't even know. I mean, I'm sitting here thinking about myself. I am liquid. I can pay my bills, but I can tell you right now, occasionally a bill like vanishes. I don't know what happens. It falls maybe between the seat cracks when my wife literally picks it up from the mailbox and drives down. She puts it in a drawer because she's cleaning up because friends coming over. And I'm like, I just got another water bill and it says I didn't pay last month's bill. What the fuck? You know what
Yeah.
happens to people that are on top of their shit? In other words,
Sure.
so to speak.
Yeah.
Um, and I could have something on my credit right now and don't even know it. And I won't know it until the next time I go to
Check your
leverage
credit.
my credit.
Yeah.
That's
And I
messed up, man.
and I think a lot of times, I think and I'd like the consumer base to hear this is like, you got to monitor your credit because you led me, Jeff, into a great segue of just a lot of people don't know what's going on in the back end, especially a guy like you own a home or something. Maybe the 22-year-old you're going to purchase him or her a car. And you're like, you know what, I'll finance and I'll give it to you. And you go down to the car dealership, and all of a sudden that bill that you forgot to pay, all of a sudden it's there. It cost you 60 points on your credit. Instead of getting a 6% interest rate on your child's car, you're getting a 22% interest rate. Because the problem with credit is that people only keep an eye on it in the vacuum of a purchasing
Yeah.
or financing scenario. They're not always looking at it. And I think from an education perspective, you got to keep your eye. And I've obviously got a lot of friends in the mortgage industry. I pull a mortgage FICO credit report every 6 months through a buddy of mine. That just to make sure, I want to make sure everything is aligned. Because like you said, things happen all the time. I've seen people pay everything on time for 30 years, and the servicer of their mortgage changes, and all of a sudden their automatic withdrawal each and every month doesn't happen because the servicer rejected it, and they didn't set it up, and all of a sudden their house is in default on a mortgage they've been paying on time for 12 years, but the servicer changed. So there's so many things that are going on in the back end. You got to keep an eye on your credit, even if you're not trying to do any sort of traditional financing.
I'm in the damn business and I don't
Yeah.
do that.
Yeah.
It's interesting. And so now from a consumer's perspective, somebody just heard what you said and said, oh, damn, I never thought about that. Maybe I should do that, like me. But not everybody has connections in the mortgage business. And you brought up a good point because not everybody understands that different credit reports read differently.
Sure.
An auto industry credit report is different than a mortgage. A credit card is different than an auto and a mortgage, and
Sure.
and the free ones you get online are completely different. And you want to give a 30,000 foot explanation on that,
Yeah.
and where someone can turn, where the best place to turn is.
Sure. I don't get too technical, but it sounds good. It's all about the remarketability of an asset. Between those, I'll address those three examples. Mortgage credit report is different from an auto. Auto is different from a credit card. They're all different from one another. If you have a $3,000 credit card with Bank of America and you stop paying Bank of America for 2 or 3 months, and then you go to buy groceries one day, you're at the register. What happens when you try to use that credit card?
Going to deny.
You're denied.
Mm-hmm.
When you purchase an auto loan or get an auto loan through Santander, and you don't make payments for 3 or 4 or 5 months, you wake up one morning to go to work, and what's not in your driveway anymore?
Mm-hmm.
The car. Mortgage is a little bit trickier. Whereas people in a home, if they stop paying on a home, I've had folks, goodness, not paying on the mortgage 6, 7 years in a home. Lights on, water still runs, roof over their head. So it's all about the remarketability of an asset. If you stop paying on an auto loan, they'll just take the car and they'll resell it and recoup their losses. On a credit card, they'll shut down the credit card, they'll take a tax liability at the end of the year. So the likelihood of them giving you credit for a car or a card, so much greater, so much easier because they can take it back. You're scrutinized a lot more for a mortgage, not only because of the remarketability of the asset, but you're on the hook for hundreds of thousands of dollars, anywhere from 15 to 30 years. So that's why the algorithms are different for the different asset, because it's about the liability that the institution takes on the back end.
I've not heard many people use the word algorithm and not in context with social media. I like it. So, all right. This has been great, man. now somebody says, all right, I've heard everything that you've said. First of all, let me actually re-ask the question. So real estate agent says I should be checking my credit every 6 months. And actually it's a bad example because they do have connections to mortgage, but what would you say to just the common person who doesn't have those connections? Where is the best place based on what you just
Yeah.
now described? Like, does
Yeah.
it matter if I go to
Sure.
the credit karmas, or does that, because that really doesn't matter. It's going to be a different looking report than the mortgage company is going to pull. So
Sure.
where should they go?
Well, shamelessly, I'll plug ourselves at UQAL. We have the ability to pull tri-merge soft pulls. It won't adversely affect your score. I can always give you an accurate credit report at UQAL. But if the government does offer annualreport.com, you can get a free credit report once a year through the federal government without any cost.
What's it cost with you guys?
Our soft pull is free. Yes. Well, excuse me. Our soft pull is free for someone that joins the platform. If you just want to come in and check your credit report and get a new report, it's $10.
Okay.
Yeah.
That's worth it. Okay. And so you're recommending, and I would just say it right there. Like, it's not a bad idea to invest $20 a year, do it twice a year, have a direct connection into a company like a UQual, because now, as a real estate professional, as a mortgage professional, as a title professional, because that's who's listening to this podcast,
Yeah.
you now have a direct connection to play hero. And
Sure.
by hero, I mean referring them over to a company that you just heard what Anthony said. Like, you're saving lives, dude. I mean, maybe that's putting it a little, that's stretching it a little bit, but that's close to it. It's as close to it as you can get. So what the process with UQual, so what is that process? So again, knowing that it's probably not consumers listening to this. If you are listening to
Yeah.
this, thanks for listening.
Yeah.
But it's probably professionals. And
Sure.
so what's the next step if they say, dude, like, I need a rep. I need to
Yeah.
be connected to UQual. What do I do?
Yeah. I can get my info out on the pod, I would assume.
Yep.
Just get in touch with me direct. Let's have a conversation. Let's talk about your client situation. Our consultations are free, not only with our real estate agents and mortgage professionals, but with the clients up front. We want to make sure that they have a quantitative path to a score increase. We want to make sure they have a comprehensive analysis of exactly what's going to get them from point A to point B. If they like what they hear, our pricing across the board, state by state, is very affordable. It's only $89 a month to work with us, and that handles the credit side, the budgeting side, as well as we throw in $1 million worth of identity theft. It's a really financial wellness tool that helps them budget, break bad spending habits, addresses credit, things like that. So
How long is the average person who signs up? How long do they have to stay inside of the platform?
it's a month-to-month contract, and really it comes down to what you're looking for from a pre-approval perspective. Do you want to stay in the program longer to drive the score higher, to get better interest rates, to get better terms, to be approved for a larger unit price? So it all really varies per customer. We're pretty good about at least giving a guesstimation up front to our consumer to understand what they're kind of get strapped in on. But we're a month-to-month organization. If a client is in the program for 30 days and he or she's like, I got to move to Mars and I don't need a credit score, well, we part as friends, and there's no long-term obligation.
Very cool. So how do they get in touch with you?
303 500 5052. And Jeff, if they mention this podcast, themselves or a family member will get a free credit report and free credit analysis.
You hear that, folks? 303 500 5052. Mention Lab Coat Agents podcast or Possibility Podcast. I think I'm going to put this out two different places, Anthony. Hope you're okay with that.
Yeah.
And hook your friend or family member up, or yourself, I guess, right? Obviously this has been a great conversation, man.
Yeah. It's been fun.
Yeah, and then we touched on a lot of things today. This
Yeah.
is crazy. It's crazy. We almost need to do a follow-up episode now just to talk about what's going on in the world, right?
Sure.
Anthony, I appreciate you, man. This has been great. UQual, it's uqual.com, right?
Yeah.
UQUAL.com. You can go check it out. Anthony gave you his damn cell phone number. You're crazy, dude, for doing that. But reach out, take advantage of that, get on his books, and schedule a time to kind of get into that arena, because I think Most importantly, again, we need as many bullets in our gun nowadays. And if you can help that one borrower overcome something that they thought was unovercomable, man, that could turn into one of the best customers, referral partners you ever have in the history of your business. And UQAL can be a partner in helping that happen. So, Anthony, dude, this has been great. It's time for us to part ways because we got to go over to FanDuel and place our bets. Go watch some basketball, man.
Yeah, absolutely. Jeff, really appreciate it. Folks, hope to hear from you. Again, you got the number to UQAL, did me direct, ask for Anthony, and please check us out.
Cool, man. Thanks, brother.
Thank you.